I don't know if you noticed, chart off, the stock market at an all-time high today. I know you noticed. And it's not just one or two stocks. It's a lot of stocks that are doing really well.
It's a melt-up.
It's a melt-up. And you know what? We haven't said that phrase in a long time.
It's a midsummer melt-up, the best kind of melt-up.
It has been a long time.
It's not your traditional December, Thanksgiving into Christmas run. This is something different. It's a midsummer melt-up, and I have very strong views on what that means for the balance of the year.
We'll keep going. I want to hear.
Okay. This is my 29th year on Wall Street. I got Series 7 license in 1997. I got a mind like a steel trap. I remember everything, as you know. Every slight, every horrible thing that's ever happened to me, every offhanded comment people thought I didn't actually hear what they had to say, but I heard it. I store it all up. And my memory of market rallies is equally powerful. If I close my eyes, I can re-experience some of these moments. And I'm going to tell you right now, this particular tape, I would say, is one of the healthiest tapes I have ever experienced. If I wrote down, if you gave me a legal pad and said, fill the first page, yellow pad, fill the first page with every characteristic you would want for a market rally in order to feel confident to stay long, like write down all the things. Here's what I would write down, okay? Earnings beats in every sector. I think we have 10 out of 11 companies are on average beating or something like that. So check. Rotations, leadership stocks getting killed and other stocks becoming new leadership. Defensive rallying with cyclical. Growth rallying with value. Large cap rallying with small cap. Revenue growth ahead of expectation. Not just games with earnings or buybacks, but like actual sales growth ahead of what's being expected. Analysts raising their expectations for next quarter during this quarter across the entire S&P 500, which is what's going on. International stock support. Lots of IPOs, but not too many IPOs. Like every single thing that I would write down on the pad to say healthy market, we have all of it.
One more ingredient, economists getting cautious.
Oh yeah, fuck them. That's perfect. I love that. Every minute that those people spend analyzing Kevin Warsh's suit and tie is another minute I have to make money in stocks. But literally, you couldn't script it better. Couldn't script it better. And you got Bitcoin falling, right? You got you can't say it's a speculative mania because you have stocks that went up 100% and then fell 40%.
How about the DGen Dow is in a 50% drawdown?
Yeah. Remember what we said. A healthy bull market takes out its own trash. Its own trash.
Its own trash.
So we had all those 2X memory people knocked out of the box. We had Leopold Ashton Kutcher, margin called into the Stone Age. Like all of that excess leverage in the Korean psychopaths, like that all cleaned itself up. And you know what the word was today out of the street? Is the bull market over? No. The bull market was reset. That momentum crash in July reset the bull market. It gave us a new foundation upon which to build future gains. We got a lot of leverage out, a lot of margin calls, a lot of 24-year-old effeminate German boys trading stock for the first time, knocked out the box, and now we're in a really good, I think, a really good position to enjoy the rest of the year. This is a midsummer melt-up. It's not very common, but when you get it, I think it says a lot about people chasing the market into year end. They're really going to do it. So I'm very happy.
You and me both. All right. Here's another one from Truist Wealth. Earnings revisions. Look at this shit. This is abnormal, folks. The average year since 2000, you're looking at the calendar year earnings revisions. And the longer the year goes on, analysts are usually too optimistic and they take their earnings revisions down. This is the exact opposite. The exact opposite.
Yeah. I mean, how much, are we normalizing this by all the write-ups of private market assets? Like Amazon and Alphabet obviously had big write-ups in their positions, and things like Anthropic. Is what you're showing me just straight up operating earnings?
I don't know, but I think operating earnings
Okay.
look just as good. So there's obviously an asterisk here, but
Just as good, but not as extreme.
it's all working. And
Yeah.
it won't forever, obviously, but
Right.
it's, these are the good times. Enjoy them while they last, because they won't last forever.
Yeah, Chart Kid Matt, as of Friday, so this is a little bit out of date, but directionally it's the same. 64% of companies have given results, 29% earnings growth for the second quarter. 137 S&P 500 companies will report this week.
What's revenue growth? Do we have that?
It's 14.1% year over year, which is 200 basis points above
That's insane.
the estimates at the beginning of the season. 10 of 11 sectors posting a year-over-year increase in profits, as I mentioned.
Do we know which one was down? I'm curious.
The lowest growth rates are healthcare, staples, and real estate. So let's assume one of those three is negative year-over-year.
Real estate.
But 11 of 11 sectors have beaten beginning of season growth estimates. And put up the one-day reactions. So Palantir today, nope, the chart kid Matt's thing. Palantir today, one-day price reactions to earnings from select S&P 500 company was by far the biggest to the upside, followed by Zebra Tech, Gartner, MCore, Lam Research, Quanta, Garmin, Micron, and Microsoft.
These are monster moves.
yeah,
in
29.5% for Palantir. So it's pretty notable. I do have some stuff from Nick and Jessica at DataTrek that I wanted to just run by you. 86% had beaten the consensus of Wall Street's analyst earnings estimates, which we know the 1, 5, and 10-year averages are 80, 78, and 76. Like the long run average is like 76, 77%.
Yeah, right.
And it always is that. We're so far above. Healthcare, 100% beat. Did you hear me? 100% of healthcare reporters beat. Industrials, 90%. Materials, 89%. The worst sector, consumer discretionary, was 75. So Nick and Jessica say the fact that more companies than usual are beating expectations is an unalloyed positive in terms of signaling strong corporate fundamentals. And then he gets into some of the technicalities. But like, just from a big picture standpoint, you can nitpick and you can find examples, but what about this? What about that? If I'm telling you that this is the overall environment, why nitpick? Why not just accept it's one of those moments in time where corporate America is shocking people left and right, every sector, every industry. Like, why not just say, yeah, that's going on. Oh, last thing
hold
from them.
on, before you move on. This is very important. If you're listening to us and you're getting nervous because we sound overly bullish or whatever, I understand that impulse. Like, I get
Yeah.
it. You have to understand and remember that all-time highs are bullish. Statistically, the one-year forward return at an all-time high is above the average for all other days.
Very counterintuitive.
So you might want to fight it and say, oh, Josh and Michael so bullish, ding, 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 I got to get it. Okay, fine, good luck.
Been
Statistically,
bullish.
statistically, these are not times to get afraid. What's your last point?
S&P net margins 14.7% in the second quarter, pulling out Amazon and Alphabet because
Ridiculous.
of those big write-ups.
Ridiculous.
So the 5-year average is 12.4.
Dude, I remember when 10% was as good as it was going to get. That was GMO's whole bearish thesis, which I understood at the
Mean
time.
reversion of profit margin.